Hello everyone! Today we're going to talk about futures and options. You must have heard about them before, but the difference between two of them is not always clear. If you want to find out what futures and options are, then keep on watching. The main differences we're talking about today in this video are connected with obligations, risks, payment, and contracts. So off we go. Number 1. Obligations. A futures contract is an agreement between two parties to buy or sell an asset at a certain time in the future at a certain price. Here, the buyer is obliged to buy the asset on the specified future date. An options contract gives the buyer the right to buy the asset at a fixed price. However, there is no obligation on the part of the buyer to go through with the purchase. Nevertheless, should the buyer choose to buy the asset, the seller is obliged to sell it. Number 2. Risks. The futures contract holder is bound to buy the future date even if the security moves against them. Suppose the market value of the asset falls below the price specified in the contract. The buyer will still have to buy it at the price agreed upon earlier and incur losses. The buyer in an options contract has an advantage here. If the asset value falls below the agreed upon price, the buyer can opt out of buying it. This limits the losses incurred by the buyer. In other words, a futures contract could bring unlimited profit or loss. Meanwhile, an options contract can bring unlimited profit, but it reduces the potential loss. Number 3. Advance payment. There is no upfront cost when entering into a futures contract, but the buyer is bound to pay the agreed upon price for the asset eventually. The buyer in an options contract has to pay a premium. The payment of this premium grants the options buyer the privilege not to buy the asset on a future date, if it becomes less attractive. Should the option contract holder choose not to buy the asset, the premium paid is the amount he stands to lose. In both cases, you may have to pay certain commissions. Number 4. Contract execution. A futures contract is executed on the date agreed upon in the contract. On this date, the buyer purchases the underlying asset. Meanwhile, the buyer in an options contract can execute the contract any time before the date of expiry, so you're free to buy the asset whenever you feel the conditions are right. So you can see that there are both advantages and disadvantages for futures and options. While options contract reduces the potential loss, you have to pay the premium which you lose in case you choose not to buy the asset. On the other hand, there is no premium in the futures contract, but you have to buy the asset at the price agreed upon earlier, even if it incurs losses. Looks like you have to take on some risk anyway, and it is up to you to choose which one you prefer.